Hey, what's up, you guys? Okay, so I saw this tweet today, and the reason I actually was not following him, and the reason it came to my attention was because TXMC liked his post, or it's actually a thread, and I just wanted to talk about that a little bit because I do find it very interesting. It ties the macroeconomic situation to the price of Bitcoin. So let's take a look. All right, so let's start with the first tweet here. The Fed has been, there has been a very fundamental shift at the Federal Reserve. The Fed has flipped decidedly hawkish. Their main worry is not employment, it is inflation. And to fight inflation, the Fed has to increase interest rates. Here's a thread about the Fed and crashing markets. So, okay, let's continue on. Okay, let's look at the second comment in the thread here, or the second post in the thread. It all started with Powell's inflation no longer transitory comment of November 30th and culminated with the FOMC minutes released on Wednesday, where the Fed officials discussed faster balance sheet normalization. The latter is worrisome enough to trigger a bear market. Okay, let's break this down. So, Jerome Powell, made this comment inflation is no longer transitory back in November 30th. So, what does he mean by that? Essentially, you can see here there's this article in Forbes where he's basically saying we tend to use transitory to mean that it won't leave a permanent mark in the form of higher inflation. So that's to say when they say inflation is transitory, they say, oh, it's temporary, it'll go away soon. However, when he said that, he's saying, okay, never mind, this inflation is here to stay. In case you weren't paying attention to the news around that time, it was kind of a big deal. So Alex Krüger is pointing that out, right? His comment came out on November 30th. What happened to Bitcoin around that time? Well, actually, what happened to all the entire stock market around that time? But us look at Bitcoin in particular. So, I am. Let me zoom out here. Okay, so I've zoomed out here to kind of show a overview of this year. We have the all-time high in April, and here we can see the all-time high in November. So, um, like he was saying, it all started with Powell's inflation no longer transitory comment on November 30th. So let's zoom in to November 30th and see what happened. Let's see here, November 30th, right around here. Look, within 3 days, December 1st, 2nd, 3rd, we see the big drop, right? The December 3rd, the huge drop. And you can pretty much see what's happened since then. Bitcoin has been hanging out in between these two lines right here. And then let's go further in that same tweet and culminated with the FOMC minutes released on Wednesday, where Fed officials discussed faster balance sheet normalization. So now let's go to that date. So he's talking about this past Wednesday. Oh gosh, I don't even know the date. The 5th. Okay, let's see what happened on the 5th. So we just saw this first drop, right? Shortly after November 30th. What happened on the 5th? January 5th. So let's zoom in here. Here we are. Look at that. Where does the 5th come out to be? Right here, December 5th. And the drop that we saw next through this support line happened right on that day. We fell through and we have not recovered up into this support level yet. I mean, if you look at the drop, we dropped through this support, found support briefly at what I'm labeling the December 4th wick. And I'm calling that December 4th wick because when that okay, so like you said, after the November 30th comment, that fall through, we wicked down to this level 42,500. And I said, okay, maybe that's a level where a lot of people have their limit buys in or whatever. So sure, we did bounce up and we didn't even come back to there for a while. The next level of support was 45,500 ish. So we hung out in that area for a while, but then like he said, after the FOMC minutes were released on Wednesday, we had another fall through there, and so let's see what happens. Briefly found a little bit of support at 42,500, then we fell through, and now we're flirting again with 40,500, which to me is like just this tremendous line of support. If we zoom out, let's see, to really look at the whole year, that line was resistance here. We broke through it in February. Okay, blah blah blah. Had the all-time high in April, came back down, broke through. We didn't hold support there, right? Broke through. Um, Here you can see it was resistance in May. It was resistance in June, and we came back down. Um, and all this time, during this time, the line of support was about 30,000. This is why people talk a lot about 30,000, is because there's a long-standing history of support here. So we bounce back up. There's more resistance at the December 4th wick, right? And then we finally punch through. Okay, and now it's support again. Here it's providing support. We go up. We have our all-time high of November. We come back down, and this is why this is so interesting these past couple of days. Is because guess what? Now we're flirting with that line again, and we're testing it as support. Um, well, excuse me. We broke through. I'm sorry, I was looking at the wrong line there. We broke through December 4th wick, and now we're even at this lower one here. Yeah, okay, so sorry about that. I think I misspoke a little while ago when I said this really this long support line at 40,500 was the December 4th wick. I'm sorry about that. December 4th wick is 42,500. This one that we were just talking about that goes back, to earlier this year, back in January even, is 40,500, and that is what we are currently testing as support right now. So let's continue from there. So the last time we tested 40,500 was back here in September, but you can think about this in terms of like momentum. Like the price came up, came back down, and we tested it. You can see 1, 2, 3, 4, 5, 6 points there, at least when you're dealing with the 4-hour chart from our perspective. But now, look, we went to an all-time high. We came back down. You can think of it like if you look at the area under this curve versus the area under this curve, you have a lot more weight coming down on this support here, as well as if you look at the aggressiveness with which it's dropped through some of these support lines. People are expecting this to be much more heavily tested than it was in the past, and some people are even calling for a breakthrough, for a fall through here. So I'm not into predictions. I don't want to get into that. I just want to present the facts and some of history. So if that doesn't convince you to pay attention to 40,500 and maybe even draw that line on your chart, then I don't know what will. So anyways, let's see what comes next here. All right, so in his next tweet, this has been extraordinarily bearish due to the speed of the Fed's turnaround. Raising rates or tapering quantitative easing should not be bearish enough to change the upwards trend across assets, but this goes beyond that. So basically what he's saying is like, look, there is a time and a place to for the Fed to raise rates, right, as he says here, and to carry out for tapering quantitative easing. This is something they have at their disposal to to react to the economy and things like inflation. But like he's saying, it's the rate at which they kind of rolled out this their stance, I guess you could say, that is really shocking people. And over the next few tweets, he goes into how they kind of changed their tune. If you look at the information provided across different meetings. And so, just like I just said, this is what he says in his next tweet. This is a matter of how fast the Fed flipped hawkish, right? So instead of them kind of like easing us into these ideas and sticking to their original plan, they really aggressively rolled out these suggestions that are what they're hinting at doing, and they even kind of changed their tune, which we're going to see in the next couple of tweets here. Okay, you guys. So here he goes through the chronology of basically the Fed kind of changing the message of what they had to say. So here starts with in June, FOMC meeting, expecting no rate hikes for 2022. So again, I'm recording this for like total beginners here. So if you're curious about what these meeting minutes are, you can go to Federal Reserve. I mean, if you just Google FOMC meeting minutes, you'll pretty much find this page. But it'll eventually take you here, federalreserve.gov/monetary policy/form calendars.htm. Basically, if you come down here, you have access to the FOMC meeting minutes. So he's referring to, in this first one, June FOMC. So if you come down here, you can, if you'd like to, read the June meeting minutes. And there's actually three things available here. There's their statement, kind of a brief summary, and you can get PDF, HTML, whatever you want, and then finally the full minutes is listed here. So if you're curious to dive into it, all this is of course available. All right, so this first point that he says here, expecting no rate hikes for 2022. When the Fed said they were not expecting rate hikes for 2022, that was a huge signal to everybody. Like, all right, like, the party is going to continue. Let's look forward to a nice bullish 2022. Okay, so to tie that comment to the graph, yeah, so they say they're expecting no rate hikes for 2022. They said this in June. If we look on the Bitcoin price chart for that time frame, that's right around, let's say the end of June was here. Yes, things still descended a little bit. We tested the line here, and then we shot straight up to all-time highs. So look, I'm not going to say that people read into that to the extent that that's why like the price shot up, but it certainly helped people's moods towards the market. So let's look at the next couple of comments he makes here. In the September FOMC, they announced they're expecting half of a hike for 2022, right? So they went from no hikes to, okay, maybe a little bit of a hike, and announcing quantitative easing, tapering would start soon. So they're saying, okay, maybe there's a hike, coming, and maybe tapering would start soon, but they didn't actually do anything. Okay, and that was from the September meeting. So looking at the chart, right here, September, and that's right when things took off. So I'll leave it up to you guys for how to interpret that. Some people might say that, the comment was saying, okay, everybody get prepared. Sometime in 2022, rates, the rates might go up a little bit, and at some point we're going to start the tapering. So they're basically saying, hey, come on, guys, you have a little more time to party. And some people will interpret that as basically, or what happened is basically people saying, all right, we have a little more time. Let's enjoy this market, and then we get to here, right? Okay. Okay. So then we get to this next point here, announcing slow QE tapering. So they went from saying, okay, tapering would start soon, to saying, yes, we're pretty much going to start QE tapering, slow QE tapering. And that happened in November, which coincides with the November all-time high of Bitcoin. So, okay, tapering's here, right? So they said, hey, we're going to start the tapering soon in September. Boom, 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 boom. Let's enjoy this party. And then they finally say, all right, the tapering has begun. And, well, you guys know the rest of the story from November. All right, let's continue with the chronology here. The December FOMC, expecting 3 hikes plus accelerated QE tapering. So they changed their tune here from slow QE tapering to accelerated plus the 3 hikes. And December, yeah, hey guys, December 3rd, right? We know what happened there. Okay, there's one more thing that I wanted to point out here. I just misspoke. I said that the December meeting might have been related to the crash on December 4th. No, it didn't, because the meeting minutes weren't actually released until later. And I actually do want to go back and talk about that for a second. Okay, so in his comment here, we need to look a little closer at this. Expecting no rate hikes for 2022 June FOMC. Okay. Let's get more specific about that. If you go to the meeting minutes page, you can see here June, the meeting happened on the 15th or the 16th. However, everything was released, the meeting minutes were released on July 7th. So when I said right here, let's go to June 15th, 16th, right here, actually the prices went down. So of course nobody knew about what they were talking about in there until, okay, June, I said, okay, the meeting minutes for June were released on July 7th. So let's go, let's see, July 7th. Okay, so the prices dropped a little more and then things took off. Okay, now let's look at his second comment here where he says, expecting half of a hike for 2022 and announcing QE tapering would start soon. September FOMC. Okay, so the September minutes, let's check the timeline there. September meeting happened 21st, 22nd, released on October 13th. Okay, let's go look at that on the chart. So let's see here. Okay, so if we go to September 21st, 22nd, let's see here, right around here, it's when the meeting happened, the September meeting. Basically where they're saying, okay guys, party's going to wrap up soon. However, the minutes weren't released until October 13th, which was right here. So, okay, so after the meeting, things pumped, but the meeting minutes weren't released until here. Things, then, we had our kind of our last hurrah after that. All right, so looking a little more closely at the Fed meeting minutes here. And again, this is for total beginners. So for those of you who know all of this, please skip the video. It's not for you. Um, let's say like the June meeting happened on the 15th and the 16th. Pretty much coinciding with that time, there is a press conference and some information about what's going on will come out right at that time. However, eventually the actual full formal meeting minutes are released, and that usually happens later. So that's why you'll sometimes see a reaction to the meeting itself. Like, okay, the meeting happened on this day. There was a press conference. They might release some sound bites to the media or whatever, giving some insight into what they talked about. And then the actual meeting minutes come out, which it reinforce what was said there. Maybe there'll be a few more surprises or whatever. So anyway, that's the way to kind of navigate these meeting minutes. Is pay attention to, when they happened, the market's reaction to the actual meeting itself, and then the secondary reaction to the minutes. Like, hey, were there any extra surprises in there that we can kind of read between the lines on? Okay, so like I said, I misspoke here on when I commented on this point here where he says expecting three hikes plus accelerated QE tapering, December FOMC. Let's take a closer look at the dates there. So December FOMC was the 15th and the 16th. So by the time the meeting happened right here. Okay, so our December 3rd, 4th dip obviously had already happened. Then the meeting occurred, and then the meeting minutes were released January 6th. So that's minutes were released. That's where this next dip came from. So this is pretty illustrative. Sometimes there can be a FOMC meeting. In this case, on the 15th or the 16th, right here, not much happened in response to that. There was a press conference, probably, so there was some information about what was discussed there, but it wasn't until the actual minutes were released that the market responded. Okay, so in the next tweet, Alex basically summarizes all of those points to say here. So in less than 6 months, the Fed went from expecting no rate hikes for 2022, right? That's his first point here, where he says expecting no rate hikes for 2022. This was the June FOMC. To expecting 3 rate hikes, accelerated taper, and discussing accelerated balance sheet normalization. So that's what he's trying to point out here is this drastic posture from the Federal Reserve and how that is what's scaring the heck out of the markets. It would have been a different story if they said, maybe if they had said early on in June, hey guys, this is the long-term plan we have over the next year for 2022, and they stuck to it, and it's like they kind of ripped the band-aid off back then, and then said, look, this is our plan and we're sticking to it. That would have probably had a different effect on the market. Maybe they felt like that wasn't the right time to do that. Maybe they felt like it did need a little, maybe the Fed was giving everybody a little bit of hopium with that. I don't know. It's hard to say what was going on. But anyways, just to come back to what Alex was saying here, it's the rate at which they changed their stance. That's what is so remarkable here. Okay, so let's go to the next tweet. Balance sheet normalization. Okay, so let's see here. Yeah, so okay, well let me go back to the previous one. So he's basically saying the stance changed, right? To expecting 3 rate hikes, accelerated taper, and discussing accelerated balance sheet normalization. Here he goes on to explain what balance sheet normalization is. He says, balance sheet normalization was not in anybody's radar for a long time. Not only is this now a possibility in the near term, but also the Fed is talking about doing so faster than in 2018. That's why crypto assets dropped 15 to 30% in the last 2 days in the last week. Okay, you guys, so to understand what he's talking about here, to look a little deeper into it, you want to pull up this graph here. You might have seen this on a lot of on the news or in different analysts' channels or whatever, or on Twitter, screenshots of this. But basically, go to fred.stlouisfed.org/series/WALCL. Okay, and when you go there, it's gonna pretty much start zoomed out. You're gonna see going back to like before 2004. Now, where he says, not only is this now a possibility in the near term, but also the Fed is talking about doing so faster than in 2018. Let's take a look at what happened in 2018. So here we can see, generally speaking, the graph is trending upwards, but occasionally it goes down. And here we can see it had been falling maybe slightly starting in 2014, but in 2018, it's going down at a higher rate. Here it was much more subtle, right? Here is where they really kicked it in to gear, and then it kind of reverse trend right around there. So I just wanted to point out that's what he's referring to there when he says the Fed is talking about doing so faster than in 2018. So one of the ways you can look at this graph is whenever the economy runs into trouble, the Federal Reserve needs to bail us out, you'll see there's a big jump. Okay, so obviously we had a economic crisis back in 2008, the housing crisis and all that. They said, okay, we got to pump a bunch of money in so that they make all these purchases. But then look, it went back down slightly right around here. I mean, I guess we can zoom in there. This is where I'm talking about. It came back down here, and I think, let me see here. Okay, so to tie this graph to the news back then, you can see here on December 30th, 2008, the Case-Shiller Home Price Index reported its largest price drop in history. So here you can see that was December 30th. Yeah, that coincides with the Federal Reserve basically, or this drop here on the graph. Okay, so zooming back out, here we can see the price. The graph just shooting up right around the time of the when the March 2020 when the coronavirus kicked in. Okay, so here I've zoomed in. I'll kind of show you. Here's the entire graph. I'm going to select from here to make it clear exactly when the price increase happened. If we move the mouse along, we can see here March 4th. Look at that. That's when they started, adding a lot to their assets. The Federal Reserve started adding a lot to their assets. So that was just the initial reaction to the really crazy, the beginning of the pandemic. So the rate here is obviously just totally insane, and they actually backed off of this. So they bought a whole bunch, and they said, okay, let's back off a little bit. They backed off, and ever since this point, I guess July 8th here on the graph is what it's showing. It's been more or less, obviously a much lower slope. It's not as this is a much higher slope, right? Much lower slope, but pretty steady. Okay. So what's going on here is pretty much every month since then. Let me zoom in a little more. We'll start here. Okay, so pretty much every month since there, they've been adding to their assets. The Federal Reserve has been adding to their assets. So they're making more purchases, making more purchases, making more purchases. Now, when they talk about tapering, they're basically saying, look, we're going to continue to buy. We're going to keep adding, but we're maybe not going to buy as much. So what that means, if you've ever taken like calculus in high school or whatever, right, we have the slope of the graph here. What they're saying is when they're going to do the tapering, the slope may change a little bit. So instead of being, this rate of increase, it'll still increase, but at a slower pace. So that's one thing that they can signal, and that's what they've been talking about. All right, so continuing with this tweet here where he explains what is balance sheet normalization, he says, what does balance sheet normalization mean? It means reversing the asset purchases conducted under QE, quantitative easing. This is also known as quantitative tightening. All right, so to change that into the graph here, he's saying, okay, the graph is going up. Okay, that's asset purchases, quantitative easing. The tapering means that the slope might actually draw back a little bit, may start to get a little more flat instead of being as in an upward direction. But quantitative tightening, that's the opposite direction. That's where instead of going up, it starts to actually go down, and that's what's really scaring people. And so if we zoom out and we look at the times when there was this quantitative tightening, we can see, like I said a little while ago, back around 2008, we saw a dip here. Basically, anytime you see the price or the graph drop, here there's a very slight, very gradual tightening. That's pretty responsible of them. But this is, a little more severe one. And the concern is, okay, look at how, I guess the more aggressive the quantitative easing, sometimes the quantitative tightening may have to be correspondingly aggressive. At this point, we've done so much in order to rein back in the inflation. They can't do a tightening like this over the course of years. No, 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 no. Well, if they pull that trigger, the downward slope may look more severe. And what he's saying here, let me see here. One of the tweets was, but the Fed is talking about doing so faster than in 2018. What he's saying is, if you look at the downward slope here, what he's saying is there's a chance that when they start selling assets again, the downward slope of this graph may be even more aggressive than this one. So that's what he's talking about there. Okay, so to continue on to the next tweet, here he says, under that scenario, the Fed goes from pumping an additional 120 billion into the economy to subtracting 80 billion from the economy. $200 billion per month difference. So let's see here. So if you go and you look at the actual numbers here, it's varied slightly, but he's basically saying on average we put 120 billion into the economy. Let's see here, per month, and so that's why this graph is going up. He's saying we might go to taking $80 billion out of the economy per month. So, if the slope was basically looking like this for injecting 120 billion per month. Let's see here. So it's going to go from that to basically subtracting 80 billion. So you can imagine, the slope is going to look not quite. It's not going to be equal, like it's not going to be down, but at the same angle. It's going to be less aggressive than this increase. But I mean, you could probably plot it out as well. And the rest of the tweets that he has are basically kind of summarizing everything and kind of wrapping it up. Let's see here. So how does this matter for crypto? Simple. Crypto assets are at the furthest end of the risk curve, right? We're talking about the riskiest stuff out there. Just as they benefited from extraordinarily lax monetary policy, they suffer from unexpectedly tight monetary policy as money shifts away into safer asset classes. All right, so basically what he's saying there is when there's, lax monetary policy and the Federal Reserve is like, hey, let's pump a bunch of money into the economy. Here we go. Look, your risk on stuff is probably going to do well. And surely Bitcoin has done well over this period of time. But when the graph starts to go down and there's tight monetary policy, the riskier assets are going to suffer. I mean, this is just, you can see this throughout history. And as he mentions, money shifts away into safer asset classes, right? So, Peter Schiff has entered the chat. But the good news for people who pay attention to this stuff is that you don't have to just look at this graph and wait. You pay attention to what the Federal Reserve signals. You pay attention to what they say in these meeting minutes. That's why it's good to pay attention to those things, because you can see this is going to affect the risk on assets. Bitcoin is so sensitive to this stuff, and so if your influencer of choice is not keeping an eye on this and not reminding you and just mindlessly telling you to hodl even right now and all this stuff, well, you might want to find somebody else to listen to. Okay, so I think I'm just going to wrap up the video now. The rest of the tweets, which are definitely worth reading through, are Alex's take on where things could go from here, next few days in the near term. So, but I don't know that that requires any kind of explanation. You know, it's pretty straightforward. I definitely recommend, looking at what he has to say there. And so, yeah, I hope this video was somewhat helpful to folks out there who are kind of like myself, just learning about all this stuff and are real beginners to navigating this. And like I said, trying to understand his comments. Yeah, some of the stuff that I pulled up here, I encourage you to also try to pull up, that Fed graph, taking a look at some of the meeting minutes, etc. Um, I think it can be really, really enlightening to look at things from that perspective. So, anyways, yeah, that's about it. All right, guys, take care. Bye bye.